Good morning, everybody, and welcome to our webinar for August 2020. Gosh, this year's romping along, but I think most of us will be pretty happy to forget about 2020. Just get through the next few months. Hope everyone's well and happy, and let's just cheer you up with some more tax, eh? All right, so what have we got? Well, what we want to cover today, I guess one of the big issues is the JobKeeper 2.0 that was announced on the 21st of July. So we do want to cover off on that and spend a little bit of time on that. There's a JobKeeper fact sheets updated with the Treasury, and then we're going to move on to a tax determination dealing with interaction of JobKeeper and the research and R&D grants and claims.
Yep.
Then we've got a practice statement draft. We've got a few tax cases that we're getting through, a demerger tax determination, give you an appeal update, and then we've just got 2 items. And I think Kirsty and I was just talking about it would be a really good idea to sort of do a bit of a stock take when you get an idea about the extent and the different reports, annual returns that you have to submit to the tax office, and just highlight 2 of them that are coming up due. And one in particular is due 31 July and another one 28 August. I'll cover off them as well. So we'll kickstart with JobKeeper. So what have we got here? Well, we've got new JobKeeper. So what happened is the Treasury completed a 3-month review of the JobKeeper system. And they've made a conclusion that it had met the initial objectives, and those were of supporting business, job survival, preserve employment relationships. So that's the sort of the ultimate importance of keeping everyone employed as much as possible and providing the income support for those that need it. So what happened was, and I was a bit sort of bamboozled why they did this. I think it was just because there was too much leaking. That on the 21st of July, which was two days prior to the July economic statement that was issued by the Treasurer, there was an announcement that there was going to be proposed changes to both JobKeeper and JobSeeker. And the announcement was for the extension of JobKeeper, importantly, right through beyond the end date in September until 28 March 2021. So it's really a 2-tier, 2-stage JobKeeper 2.0, so lots of 2s in there. And so, you know, that's the fundamental difference. So we've got a new JobKeeper that's kicking in on the 29th of September, and it will run right through until 28 March. Now, we've got an announcement only at this stage to go on, and of course we'll cover, it probably won't be by next beginning, we'll be able to cover it, yes.
I think so.
So I think that the key is that under the coronavirus package legislation, you'll recall that there was the framework for how JobKeeper works, and then there was a specific legislative instrument that gave the Treasurer specific powers in relation to JobKeeper. Now, the JobKeeper was provided that there was a capability for the Treasurer to extend the date of JobKeeper beyond September, but only until 31 December. And now, because we've got this announcement of JobKeeper being extended until 28th of March, it will need amendments to the coronavirus legislation that we've got. And most likely what will happen is similar to what we've got at the moment, where there's the framework, which will extend the date of the JobKeeper legislation until March, I would expect. And then there'll also be the specific legislative instrument that will be given to the Treasurer to make rules, the ability to make rules under those legislative instruments that will be given to him and beyond March. So it will be interesting to see where it goes. So legislation, stay tuned. Parliament reconvenes on the 24th of August. So I would anticipate that is pretty much when we'll see the legislation that first week of sitting. Actually, they won't be sitting. They're not getting together to sit. They've announced that, haven't they? So, yeah. So it'll be
remote,
I think, or I think they were saying practically that wouldn't work either. So, yeah, I'll have to actually
they'll need to have some rules because we need to know by September.
Yeah, that's right. So it will be before the start date of 29 September. In some way, shape or form that we'll get the legislation. So we'll be able to go through that with you next month, I'm sure. So the $1,500 per fortnight rate for JobKeeper is going to be reduced successively over 2 stages. So there's first stage and a second stage, which I'll go through in a minute. And the other part of it is there's also 2 tiers. So there's the full rate, and then there's going to be a partial rate, which is based on a threshold of minimum 20 hours per week being employed or actively involved in a business. And I'll explain that as well. So the important thing just to bear in mind is that the current JobKeeper, there are no changes. So it stays status quo until it runs its course until 27 September. And then the new JobKeeper 2.0 will kick in on the 28th of September. Okay. So the just on the job seeker, so that has also been extended until 31 December 2020. So it doesn't go as long as JobKeeper, and there has been some criticism about that. And likewise, there is a reduction to $800 per fortnight. And I've got a schedule in the next slide as well. But so the payments are scheduled to end 31 December. And just to highlight for you, the total cost of the JobKeeper has been estimated, which was covered in the economic statement on the 23rd of July. JobKeeper 2.0, the cost there is anticipated to be $15.7 billion, bringing it to a total of $86 billion, which, as you will recall, is still shy of the initial estimate. I think, was it 130 billion?
Yeah, I think so.
Yeah. And so we know that there was a little bit of a miscalculation or
miskeying
of the calculator there. So anyway, so we've still well under the initial estimate, to tell you the truth. So yeah, so that's just touching on the job seeker. So I think now we've got just a table here for you, and hopefully this clarifies it. So we've got JobKeeper, so more than 20 hours per week. Currently, as you know, it doesn't matter whether you work 20 or less, it's all flat $1,500 per fortnight. From 28 September through to 3rd of January, which is the first stage of JobKeeper 2.0, it will be $1,200 per fortnight. And then for the second stage of JobKeeper 2.0, from 4 January onwards until it ends in March, it's $1,000 per fortnight. So you can see that it's this whole concept of not just stopping dead and the falling off the cliff of the economy, but there's a phasing out, so it drops down to $1,000. Less than 20 hours per week, it will be a significant drop for those people that are working less than 20 hours per week, and that'll drop to $750 a fortnight for the first stage, and then $650 per fortnight for the second stage. The job seeker payment there, as you know, currently it's $1,100 per fortnight, which includes that coronavirus supplement. And then up until 31 December, it will drop to $800. And then the intention is at this point to revert back to the normal payment under the New Start allowance. So the removal of that $550 and then $250 supplement will disappear. Okay, so let's just sort of go through a few things and just to clarify it for you. So the eligibility requirements for Job Seeker 2.0 is essentially the same eligibility requirements as what exists in the legislation at this point of time, with the exception of a change of testing for the decline in turnover. And the change fundamentally, the big issue is it's just going to be what is your actual GST turnover. So the thresholds for what is the percentage decline in turnover that you need to satisfy remains unchanged. So we've got this concept, as you know, first is, well, what's the percentage decline that you need to satisfy to be eligible for JobKeeper? And depending on your aggregated turnover, more than $1 billion, less than $1 billion, or Australian charities and not-for-profits registered, is 15%, 30% and 50% there. So that's the thresholds that we've got at the moment. They remain unchanged. So that is not an actual turnover, like actual GST turnover. we just go back to what is your aggregated turnover, which, and that there's different tests that apply there. So the turnover for the threshold percentage to apply is expected to be unchanged, but the decline in turnover test will change. So what will it change to? Well, what actually has to happen is for the first stage, which starts on the 28th of September and goes through to the 3rd of January. Actually, it will technically start on the 29th of September, won't it? Or is it 28th?
28th.
Oh,
yeah,
sorry, it is the 28th.
Yeah,
It finished on the 27th, yeah. You need to prove that the actual GST turnover has fallen below the thresholds, and the thresholds is that 30% decline. And you need to satisfy it for the first stage that goes through to 3rd of January for both your June 2020 and September 2020 quarters. And so there's a comparison that needs to be done with the corresponding quarters in 2019. So, and then the second stage, which runs from 4 January 2021 to 28 March 2021, you also need to satisfy, and that requires the actual GST turnover has fallen below the thresholds, and it captures the 3 quarters. So you've still got to satisfy June, September and December quarters compared with the corresponding quarters of 2019. So let's just talk about a few things here. First of all, the rate. As I said before, there's a full rate and then there's the partial rate. Now, the first and second stage of JobKeeper 2.0, you will be eligible for the full rate, and the way that you test that more than 20 hours per week threshold is you have to go back. It's irrelevant what you're doing in this JobKeeper period. What you have to do is go back to basically the month of February 2020. And the employees there, were they working in the business more than 20 hours per week on average? Now, we don't have clear guidance on what on average means. Is it sort of like for the whole year? But my understanding is it looks like it's on average for that month. Mm-hmm. Just because of the examples in the Treasury fact sheet, they say, look, there's a special discretion we're going to offer up. There'll be an alternative test where the hours were not usual, and they specify for February. So my interpretation of that is that it's on average more than 20 hours per week in February. Special discretion available to the Commissioner. The examples that are given is if that person was on extended leave, whether they were volunteering, for example, fighting the bushfires. Again, reminder what a terrible year it's been. Mm-hmm. Or you weren't employed for all of February, so there'd be a proportionate reduction of the testing there, or maybe sort of you broaden it out like you do with turnover. So that's the threshold there. Now, one thing that I was struggling with is, okay, well, that's fine where you do actually employ people, but what about for eligible business participants like your sole traders or like your directors of companies that are not actually employed by the company technically, but they have an ownership or they have directorship? How does that work, and how do you test that? Because obviously,
how do you prove it?
How do you prove it? Yeah. So this is sort of, I think some sort of records being ready if you're going to be questioned. And again, the importance is it doesn't matter what's happening now. It's back to what happened in the month of February 2020. So I think there'll need to be some guidance there, because remember, the concept is for eligible business participants, one of the requirements, you need to be actively involved in the business. So if that was less than 20 hours per week, then the partial rate will apply. Okay. So the next thing is just one thing I think that's an issue, but we just have to deal with it, is the timing. So the first fortnight under stage 1 and the first fortnight under stage 2, so like for the January fortnight and also for the September fortnight, they'll actually end before the VASs will be due. So what you need to be able to really work out before you start claiming JobKeeper for that first fortnight in stage 1 and stage 2 is, well, actually, what is the actual turnover? So you need to work out the actual turnover for September pretty quickly by the first or second week of October, well before the VASs are due. So, and because it's actual turnover, I guess, you know, just get prepared, be organised, and just sort of be on the front foot there. So that would be the message there. And in particular as well, that will happen in January. So the key here is it's almost like a build effect. If you can't satisfy the June 2020 quarter decline in turnover, then you won't be able to access either the first or second stage JobKeeper payments. So what actually happens is collectively, the first and second stage, it's testing really for 3 BAS quarters, being June, September and December. You need to satisfy the first 2 quarters, which is June and September, to get the first stage JobKeeper under 2.0, and then you need to satisfy all 3 quarters to get to the second stage. So just to give you an example, like, you know, I always talk about my sister, the hairdresser. So she's been eligible for JobKeeper this whole time. I've just had a quick look, and her June quarter BAS for, you know, her actual sales for 2020, I think that she's not down. She was significantly down and dropped for a month, which is why she was eligible for JobKeeper. The overall June 2020 quarter is not more than 30% less than her June 19 quarter. So she'll be out of JobKeeper with effect from the end of September. So even though she might drop again, you know, in December, it's bad luck. She'll be out because of what happened in the June quarter. You know, but that's good news for her because it means she's sort of building back up again. Mm-hmm. So hopefully that just gives you a practical example of how you will apply the test. Now, a couple of things there, of course, still on my sister, is that she's not registered for GST, and this is all based on actual GST turnover. Mm-hmm. And the Treasurer has also said there's going to be some special concessions and considerations for people that are actually not registered for GST. So I think there'll just be some guidance in relation to that as well. So that obviously will be, stay tuned. And the other issue, of course, is that there's still going to be a discretion for the Commissioner available for the alternative test to still be available. So the Treasury has indicated yes there. So all those alternative tests, like for service entities and startups, etc., should still be available for the JobKeeper here. Of course, as a practical matter, like the startup one, I don't think that's really going to work, because if you've got a new startup now, mm-hmm. it's just not going to work because you needed to have an ABN, etc., back in March.
Yeah, well, if you don't qualify for the first JobKeeper, you don't even...
No, that's not right.
I don't think so.
Yeah, really?
So
even if you... And they specifically say that. Sorry, Kirsty.
Yeah, okay. No,
but I think as long as the eligibility requirements about ABNs, employees, etc., that exist at the moment, but then if your turnover hadn't declined enough, you know, for the first period in April, May, June, say, but now it does, you will be eligible for JobKeeper 2, even though you weren't for the original JobKeeper, as long as you can satisfy all those core provisions, the eligibility. But if the only thing that you're relying on to get into JobKeeper 2 is the turnover now is worse, then you will still qualify.
Okay.
So, yeah, and it does say that in the Treasury fact sheet as well. It's quite confusing, but I think that, you know, that's sort of how it works. So the other aspect is you'll need to nominate for each eligible employee, whether it is the full rate or the partial rate that applies. And my in bold there is take care and keep records. So that's going to be really, really important because the onus will be on you for nominating the 20-hour test and how that all works. What was the other thing I was just going to mention there? Yeah. So the Jeremy Hersham from the ATO has also indicated, he gave us a little bit of I think there was a bit of media coverage about, well, practically what is it going to look like, JobKeeper 2. And he's confirmed, the ATO has confirmed, they're currently working on a new application form, and businesses will have to reapply. So, and obviously it's because it's a whole new turnover test, threshold test. And so you will have to reapply for JobKeeper 2, even though you have submitted and qualified under the JobKeeper that we have at the moment. And the other aspect to this is what they're, you know, trying to streamline the process. It should be an online process. And again, I think through accessing your MyGov ID credentials, which is similar to what you had to do with the original JobKeeper, that will continue on. They're going to try and pre-fill as much as possible. And so I think hopefully it will be fairly streamlined, but then it will be, you know, a matter of we still do have to reapply. And their expectation is, I think it's about 900,000 businesses applied for the first stage of JobKeeper, and the expectation is the number will be less. So yeah, yeah.
Yeah, we've had a question. So the question is basically, just to paraphrase, that in one quarter you're expecting the revenue to be up, but overall for the year you're expecting it to be down. I don't think that will matter because it'll be a quarter by quarter test. So you'll need to satisfy it for the June quarter and also the September quarter. So unfortunately, unless there's some sort of alternate test that they come out with, I think that would be the way it's going to be applied.
Yeah, and I mean, that's a perfect example. Is it Roy?
Yeah, Roy.
Thank you, Roy. Of, you know, which is what I said before, it's almost like a build. If you got to satisfy June and September. So even though June might have only been down 25%, and then September is disastrous because you're in Melbourne and it declines by 70%. And on average, it's less than 30. It doesn't work like that. And then, so the big issue, the big issue there is, I've mentioned, there is, you know, with the second wave hitting Victoria, there is a lot of controversy regarding the 2 extension periods. It's rough. I think that's really rough. And I think, you know, we should keep the pressure, and hopefully we're going to have some announcement about that, because exactly your example, Roy, would be a lot of Melbourne businesses where they'll just reopen, just starting to recover for the June quarter, and then it's shut down again and it's disastrous for them. And, you know, clearly need help and support, and JobKeeper, hopefully they make some changes to, you know, sort of not make it for both those quarters to apply, for example. So we'll have to stay tuned for that one. Okay, so the just to let you know, there's a whole heap of Treasury fact sheets that are there for you to look through. That's all we've got at the moment. Probably the best one. It's only about 3 pages, but it does have a practical example of how it applies, which is exactly to your question, Roy. I didn't put it in because it was just really obvious, because they failed in June because it was 35%, and then they failed in September because it was 70%. They should have had one where it passed and failed. Anyway, so that's all the fact sheets that are available there for you, and hopefully that helps you with understanding this new JobKeeper 2.0. And we will cover it next month when we get the legislation.
Okay, good. Yep, that's on the fact sheet. Okay, so I'm going to start talking about draft tax determination 2020 D1, which is again on JobKeeper, and just how it interacts with the research and development provisions, and whether or not you get an R&D deduction for wages that you've paid to people that are actually doing R&D activities and would normally fall within the R&D deduction realm, but because they are you are receiving JobKeeper payments for them, and you know that you're going to be receiving those JobKeeper payments, it's whether or not those wages are considered at risk. And for something to be deductible under the R&D provisions, the amount needs to be at risk. So the draft TD goes through payments made to employees and also payments made to people that are just, you know, the business participant. So with the employees, if there is an expectation that you're going to be receiving that JobKeeper payment, and it's in relation to that employee that is doing R&D activities, then that payment is not considered at risk, and it would not be considered incurred in relation for the R&D deduction. So we'll go through an example and show you how it works. Differently for the business participant, because their expenditure isn't exactly related to having received the JobKeeper payment, they are not, they're not prevented from notionally deducting expenditure that they have incurred, I guess, because there is a direct relationship between the employee's actual wage and then performing R&D activities, and the JobKeeper payment being sort of a reimbursement of that. whereas the business participant is just receiving the amount for being actively involved in the business, and then other expenses, there's not actually a wage amount paid to them. But I guess if there was some sort of connection between like directors' fees or something like that, then that could be seen as differently, and you'd need to look at whether or not that director fee was actually at risk.
And I guess it kind of makes sense in a way, because it's more like a business support payment, the eligible business participant amount, because it goes to the entity, doesn't it?
It's not really connected with the wage.
Gotcha.
Okay, so I think we're just... So you need to, there is a distinction between whether or not someone is wholly engaged for R&D activities, or whether they're partially, so their wage needs to be proportioned into the amount that relates to R&D and that doesn't. And if it is a partial, that they're only partially involved in R&D activities, then only a portion of the JobKeeper payment would be seen as applying to that wage, and therefore not at risk, and therefore not eligible for this R&D deduction. So let's have a look at an example, because I think that would be the best way to do it. So this employee is wholly engaged for their R&D activities, and the wage is more than the JobKeeper payment. So Cameron is doing all of his work, it relates to R&D activities. He gets paid $2,000 per fortnight, and so when they receive that $1,500, his employer, the $1,500 that they receive that relates to JobKeeper is not at risk, and therefore not eligible for the R&D deduction, whereas the additional $500 is considered at risk, because there's no expectation of a payment in relation to that amount. So in that example, $1,500 not eligible for R&D deductions, $500 is eligible for deductions. This is where, sorry, I think this is still continuing on with Cameron, but where the employee is only partially engaged in R&D activities, the Commissioner will say that based on a time basis of how much that employee is actually working for R&D purposes, then that is the percentage that you would apply to the JobKeeper payment as well, to say whether or not that portion is at risk or not. So say, for instance, an employee was 75% of their time was in relation to R&D activities, then 75% of the JobKeeper payment would be applied against the wage, and the difference would be the amount that is actually at risk and eligible for the R&D deductions. So probably something that probably not going to pop up that often unless you're in the R&D space, but just something to bear in mind if you have got clients that normally have employees who are performing R&D activities, and just to let them know that not all of that amount, because it hasn't been at risk, will be eligible for the additional R&D offset and other things.
It's still just deductible like normal
Still
wages,
deductible, yes.
And accessible, of course, on the way in.
Exactly. So yeah, it doesn't change the fact that you'll get a normal deduction, but just that extra R&D offset, not eligible.
But if you pay more, and you covered that, didn't you? If you pay more than the $1,500, you can't do a FIFO basis and argue, I guess it wouldn't work. It's just the total, like the extra amount is clearly available.
Yeah,
still.
It's whether or not it's at risk of being reimbursed for it, kind of thing.
Okay.
And so that $500 in my example was still at risk, because they weren't getting any compensation in relation to that amount. Okay. So next one is another draft, but a PSLA this time, on how the Commissioner is going to apply his discretion in relation to remission of super guarantee charge after the amnesty ends on the 7th of September. So as we all know, and probably haven't had time maybe with all the other things going on, the deadline for the super guarantee amnesty is coming to an end. Got a month and a day until it's at its end, and that we need to help clients and ourselves, if it's relevant, to make a disclosure to the ATO that there has been maybe a shortfall in one of the qualifying quarters, or maybe you haven't had a shortfall, but you just haven't actually done the SGC statement. And I mentioned that because sometimes people think that just by paying the amount of super guarantee that they've fulfilled their obligations, but unfortunately that's not the case. The SGC clock still keeps ticking until you have actually lodged your SGC statement for any quarter where you would have paid late of the obligations.
I don't understand why they link it to the lodgement of the statement for the penalties, etc., and not the payments. But anyway.
Yeah, I know. It's just
so
an
important.
anomaly with the,
Yeah.
and I mean, they do, and I just highlighted down there in gold that the Part 7 penalty is not a penalty on the employer for failing to meet their SG obligation. It is a penalty on the employer for not promptly disclosing to the Commissioner that they have an SGC shortfall. So it's within the law. That is what the law says. It doesn't, the interest clock doesn't stop ticking, or the penalty doesn't stop ticking until you've actually lodged that SGC statement. So
Wow.
it's probably a not well known fact, but just say you have a employer who has actually paid late and they like pay the next week or something like that, and they think they're all done and dusted. Unfortunately, that's not the case unless they've lodged an SGC statement. Another thing I just wanted to point out, this is dealing with Part 7 penalty, which is an additional penalty to the actual SGC amount. So with super guarantee charge, it's made up of 3 things: the actual super amount that is late, the admin component, the $20 per person, and then the notional interest amount. So under the amnesty, the admin fee and Part 7 penalty doesn't apply, but this practice statement is looking at after the amnesty, how are the Commissioner and the ATO going to administer remissions of this penalty, because it's quite a harsh penalty. It can be up to 200% of the SGC amount. So I think basically you could be paying 300% of, because you've had the actual SGC amount and the penalty. That's how I interpret that. So when the amnesty came out with all the rules, they were quite clear that they were going to be quite harsh with this penalty and not remit unless there were sort of circumstances that were outside your control, or you needed I don't know what the word I'm looking at, but like bushfires or those sorts of things. And so now, to be consistent, they have released this practice statement so that anyone that comes forward after the amnesty, there is a consistent way, and you'd be able to work out, I guess, roughly how the ATO should apply this Part 7 penalty. Okay, so the way that they're going to do it is there's a 4-step penalty remission process. So the first step is they set a base penalty level, and we'll go through how that base penalty works in a minute. Then they determine if there's any reason that you should uplift that penalty. And that's basically based on your employer's compliance history. And that doesn't only need to be your compliance history for super, it can also be your compliance history for other things. If you actually have a good compliance history, it just means nothing happens at step 2. But if you have a bad one, then you could get an uplift. Step 3 is about identifying any mitigating factors and circumstances. Did you take voluntary action to notify the Commissioner before he came about and told you? And taking into account other factors that may happen. So this, I guess, could be if there was, again, bushfires or other things. And actually, sorry, that would probably be taken into account in step 4, identifying any exceptional circumstances that prevented the lodgement of the SGC statement. And they might look at COVID here or bushfires and things like that. So just looking at how the base penalty will apply, basically if you're at the top of the chart, you're the really naughty people where no remission will happen, and that's basically your Phoenix arrangements, and there's a repeat history of this happening, and maybe you've been a director on different companies and they can see that. It gets better if you actually come forward voluntarily and contact the ATO, and obviously the better your compliance history and the more more reasons that you have for failing to make the SGC statement in time will help your case. And so, you know, natural disasters and impacted by COVID can also be reasons that maybe they might take into account. But with that COVID one, I will just go through an example where they didn't really reduce the penalty. So this is an example of where full remission was decided because the ATO, they lodged the SG statements after the date, but prior to the ATO making contact with them. So they decided to remit the penalty initially to 90%, and then they took into account that the taxpayer's compliance history was good. So no further uplift was applied at step 2. And then they further took into account that the employer was going to upgrade their payroll software, and they were going to undertake some education. And so they decided to remit further to the 10%. So that was a full remission one. So obviously coming forward with it and having a good compliance history was key there to get the full remission on the Part 7 penalty. Just noting again, that doesn't mean that the SGC part has gone away. You still have to pay that, and the Commissioner actually doesn't have any discretion to reduce the admin component or the interest component. So this is just the Part 7 component, which is the 200% penalty. This one I just thought was interesting to point out that they were going to apply a 50% remission because the employer had lodged the SGC statement after the ATO compliance commenced. There were no other factors in step 2 or step 3 that needed to be uplifted, but they had tried to say that COVID-19 had impacted the employer's ability to disclose from March 2020 onwards. However, they could not provide evidence how that had stopped them from doing anything from 24 May 2018 when the SGC amnesty period started, and, you know, with COVID sort of happening around March 2020, what had happened in that period. They had almost 2 years there to have done something. And so I think COVID isn't going to be a reason that they really take into consideration, unless you can explain why for the 2 years before you didn't do anything as well. And then in addition, COVID hindered you after that point. So in this case, they just left it at the 50% remission there. So
I think it's interesting, like it's pretty harsh. If you're completely unaware,
yes,
that you had an obligation, it just doesn't matter. Like compared to Division 7A,
yeah,
where, you know, if you're sort of unaware of a deemed dividend, there's a commissioner's discretion to, you know, sort of exercise the law under 109RB and not impose it to be a deemed dividend, for example, as long as you take corrective action.
Yeah.
Nothing like that here.
No. So I feel like in that scenario, Vanessa, you would be in the item 5, the 50% remission category. Right. So, and they would probably put you on an education program, and then that education program can then further limit or provide them with discretion to maybe reduce it lower. But I think if you don't know about it and then they tell you, you're starting off at the 50% mark, which means 100% of the SGC, because it's 200% is the actual Part 7 penalty. So 50% remission gets you to 100%.
Wow.
Yeah, so it's really, really, really harsh. So you want to be encouraging everyone to look into this during the amnesty period. So in this 1 month, 1 day we have left, check out what you've got, because the more things that you could have come forward with and you don't, the harsher they're going to be. Yeah.
Interesting. And I think the trap, isn't it, of course, is the SG statement. Don't just think, okay, I'm within the amnesty period, I've paid the outstanding super.
Yeah.
It's the statement needs to be lodged before 7 September to get within the amnesty as well.
That's true. Yeah. So you've got to do all of that. And I mean, if you can't, so it's better to come forward and do the SGC statement, even if you can't pay the amount within before 7th of September, at least you'll get the benefit of the no admin penalty and this more favourable treatment under the Part 7 penalties. You might not get the tax deduction because you haven't paid for it before 7 September, but there are other benefits, I think. So definitely get in and report to the ATO if you know that there is something out there.
Yeah. And I guess the release of that practice statement does not bode well for the amnesty period being extended.
No. Well, I mean, they were pretty clear on their website that they weren't going to extend it.
Interesting.
Yeah.
I just was on a Tax Institute committee call before our webinar, and you know we were talking about it because all the professional bodies they're continuing to lobby government to extend the amnesty period.
So, I guess they're thinking that we've had since 24th May 18 or March, and but yes, it is. You know, we've got a lot going on at the moment.
Exactly. Okay, so this tribunal case, I think this was a carryover. Oh God, okay. So yes, so another example of a taxpayer failing to prove that their amended assessments were excessive. So it was a fellow who operated business here in Australia as a sole trader, and one of his key customers was a company in the Solomon Islands that he had been related to, and they're a supplier of bottled water and soft drinks. And so somewhat confusingly, the arrangement was that the company that supplied bottled water actually would sell to other companies, Logistics Company 1 and 2. And so what actually happened was Logistics Company 1 and 2 would they purchased the bottled water from the Solomon Islands company. But what they'd actually do is, rather than pay the Solomon Islands company for the water they purchased from them, what they actually did was say there was an arrangement between the three of them where the company would buy off the taxpayer here in Australia, and then those two logistics companies that had bought the soft drink would actually then just directly pay the taxpayer here in Australia. So there was sort of like an offsetting agreement between the three of them. And the whole, ostensibly, it was all to sort of avoid foreign currency complications and exchange costs, etc. So, and what was meant to happen was then there was a shoring up, and then if there was any shortfalls, they would be subsidised. Now, of course, this arrangement all happened, and as you can tell, it was all fairly loose. And the issue was the taxpayer here in Australia was also a shareholder of the company, previously a director of the Solomon Islands company when he lived there. He resigned in 2013, and he originally held 50% of the shares in the company as well. So there was some clear relationship there with the dealings with the Solomon Islands company. So what then had happened was there was a notification that they'd actually overpaid an amount. So they said the correct amount that they should have paid was 2.12 million. So there was a significant overpayment. And the other bit that was more complicated with this was that the Solomon Island company had also purchased 2 properties from the taxpayer, and that was also offset against the monies that those 2 logistic companies that bought the bottled water, they also paid, and sort of was offsetting the purchase of the property there. On top of that, there was ostensibly some advisory services that was provided to the bottled water company in the Solomon Islands because they were interested in purchasing some brewing equipment from an unrelated party in China. So what had happened with all that complexity of dealings that happened, and obviously there's going to be significant deposits coming from overseas into the bank account of the taxpayer here. You know, the tracing, I'm sure, would have been of interest to the Commissioner. Where'd the cash go? Why haven't you reported in your tax return? And obviously then there was an audit, and the Commissioner provided the taxpayer with a position paper and basically looked at the deposits and the amounts that had come into the bank account and said that it was assessable as income for the taxpayer. There was an imposition of penalties of 50% because of reckless behaviour. So the argument that the taxpayer had is, well, I recorded all on a cash basis. And look, there's generally a margin which is sort of in keeping with industry average. And the excess amounts that he received, remember that was the overpayment, the supposed error in the translations that happened from Solomon dollars to Australian currency should not be ordinary income there as well. And so that just sort of gives you an idea of the scale here of the amounts that were emitted. You can see it's sort of like, you know, a couple of million here for one of the years. So it did go through all of the years, and there was an increase that was assessment there. So the issue was whether the overpayments received by the applicant were assessable as ordinary income. So remember, these were purported overpayments. And what I just think is interesting about this case is it's a section I haven't really ever focused on, which is section 59-30 of the 97 Tax Act. And it says that an amount you receive is not assessable income and not exempt income, so obviously doesn't impact the losses there, for an income year if you must repay it and you repay it in a later income year, and you can't deduct the repayment for any income year. So it's basically, I guess, it's derived, you've received it, but then there's subsequently, after, there's some later events that require you to have to repay it. And this section is basically saying, look, it's just not your assessable income. And so there's an unlimited time to go back and amend that sort of thing. And I think it's just an interesting one. You know, we've got the flip side of an assessable recoupment where you've claimed a deduction for something. And then, you know, there's a recoupment of that amount. And it's just making sure that's accessible. But what this is doing is just making sure it's actually never accessible. So it's recharacterizing it, basically saying, even though you thought it was accessible back in that year, the obligation to repay means that it's actually was never accessible in the first place. So I just think it's quite an interesting section. And we've got some similar rules, haven't we, in the CGT provisions with cost base and proceeds as well. So it all makes sense. And that was, you know, an interesting section. I think it's just sort of worthy of mentioning it. And so the last part of the section says, it doesn't matter if you receive the amount as part of a larger amount or the obligation to repay existed when you received the amount or when it came into existence later. So on the face of it, you're sitting here thinking about this guy with the dealings with the Solomon Islands company and the logistics company and the offsetting arrangement. There was, you know, he sort of received all these amounts, and then there was actually, well, actually it's you know, it's an error and you need to repay it now. And, you know, I think, you know, it could, on the face of it, satisfy this provision. But of course, the problem is the burden of proof that is imposed as on taxpayer, you know, where there's an amended assessment being issued by the Commissioner. The onus is on the taxpayer to prove that the Commissioner's amended assessment is excessive, and you've got to prove what's the correct amount. And the lack of him being a credible witness, like there was sort of like a trail where they said, actually, no, it wasn't $2 million, it was a lesser amount, and we converted and we used Samoan dollars instead of Aussie dollars. And so there was holes poked in the evidence, and basically they did not discharge the burden of the onus of proof. So unfortunately for the taxpayer in this scenario, the whole amount was accessible. So, but I think it's just an interesting one, just that section, which to be honest, I've never really focused on. So that's that reporting of that case. Cereboo, we hadn't covered either last month as well. Oh yes, so this one, I think what's interesting here is there was 8 paragraphs of this 33 paragraph decision issued by the Administrative Appeals Tribunal, which went through a lovely story about the Rum Rebellion back in 1808 and the problems of a currency that's not the sort of the proper government currency that's recognised as being legal tender. And so, you know, the problems that we had of inflation and crime and when rum was the currency as opposed to Australia having a coin. So anyway, so it was quite an interesting history lesson that we had there. But what it's all related to in this case is a taxpayer who obtained a private binding ruling, and it was to do with dealing in Bitcoin. And what the taxpayer sought to have the Commissioner determine was whether or not the loss that was made in dealing in Bitcoin, whether or not it was subject to Division 775, dealing with foreign exchange gains or losses. And as we know, that provision, if there's a foreign exchange realisation event, of which there is four or five. Yeah.
Yeah, I think it's an odd number.
Yeah, I think it might be 5.
Yeah.
And so if there is a foreign exchange realisation event, then either that gain or that loss is assessable or deductible on revenue accounts. So it's not a capital affair. And so the taxpayer here had gone forward. There was the acquisition. I still struggle with the concept of cryptocurrency, but nonetheless. So there was a 0.56 Bitcoin that was paid over instalments during the 2018 year, the $5,300 value. It was settled with a payment of 0.5 of a Bitcoin, and then there was 0.6 of a Bitcoin sitting in this sort of cryptocurrency wallet. I wonder if it's a bit more sophisticated than an Apple wallet. So there was a realisation event of $856. So the discussion, which is sort of the relevance of the Rum Rebellion here, foreign currency is a currency other than Australian currency. So I guess akin to rum, the ATO confirmed that Bitcoin is not a foreign currency, and the reasons were that an Australian currency refers to a unit of exchange established in the Currency Act of 1965. The context in which the expression currency other than Australian currency seems to imply that the other than a currency other than Australian currency is basically saying that the comparative here is the other currency needs to be some sort of sovereign currency. And it wouldn't be Bitcoin because it's not an official currency of some other sovereign state. So essentially, failure on getting losses for cryptocurrency being on revenue account, essentially. So the issue then that you've obviously got is capital gains and losses. There is tax determination 2014-25 that does deal with this issue. There was discussion about the personal use argument. And I think when Bitcoin and, when Bitcoin went berserk a couple of years ago, when it increased significantly in value, there was a lot of argument, well, it was actually acquired, it was less than $10,000, it's a personal use asset, so it's not going to be accessible. But of course, the reading down of that and the examples that have since been published by the ATO on the website, and there's quite a lot published on the website, the concept and the examples that they give is if all that you're doing is buying Bitcoin for things like gaming, I think would be one example where you can go and buy, skins or whatever it is in the latest games. Yeah, I know about this. Yeah. Then that might be an argument where any sort of anecdotal or sort of by the side gain that happens may well be not subject to CGT, but by far and large, for most of our clients, it's going to be, if it's on capital account, it will be a CGT event, and you need to be subject to the CGT provisions for that.
Okay. So Duncan is a case that got handed down this month, where he was a director of the Keystone Group Holdings, which operated restaurants, bars and hotels around Australia. And he'd been employed for a while, dating back to 2000, and was director of various entities within that group. And then there's quite a few background facts there, but just to summarise, the business started to be trading insolvent, and some receivers were appointed to administer the Keystone Group, and they actually formed the view that the Keystone Group had demonstrated indicia of insolvency from back in December 2015, when he was a director at that time. They had told the taxpayer, Mr. Duncan, that his final date of employment was going to be at the end of May in 2017, and then moved that forward. And the liquidators were appointed and were doing the necessary things to wind up the Keystone Group. The liquidators executed an agreement with a Hong Kong registered company to assign the right to sue the various directors, including the applicant. And so Mr. Duncan had gone and had some legal advice and had paid $100,000 for full and final settlement of all legal actions that could come against him as a director in the Keystone Group of companies while trading while insolvent. And so the issue of this case was whether or not the payment of that $100,000 was in gaining or producing his assessable income. He had argued that because he had been, he had been employed throughout that period as a director and been remunerated throughout that time, that this was in relation to gaining or producing his assessable income just under the ordinary deduction provisions. The Commissioner and the AAT agreed with the Commissioner, viewed this as a capital payment, that the true advantage sought by this payment was to avoid any litigation in relation to his role as director, and also in relation to protecting his reputation and ability to continue to be employed in the hospitality industry in a leading role. And because your reputation is akin to sort of a capital asset, that was one reason that they thought that this payment was also capital in nature. They also did look at, well, it was also a one-off payment, and normally your income, a payment in relation to income would have a nature of reoccurrence, and this one didn't. And so another factor in to support why it was capital. So overall, they considered this outgoing was capital in nature, which I think is just the right. Oh, you don't think?
I'm pulling a face here.
Oh,
what about Snowden and Wilson, which was that one where where they were defending wasn't there criminal charges against the directors and there was legal expenses incurred, but I think they said that was part of the ordinary risk of conducting the business. So maybe, I was just
this one, he had already ceased to be a director when he paid it, and it really was, they attributed it to his reputation and also ceasing legal action.
Yeah.
They did look at Day's case, because that was one where they had considered that the legal expenses were deductible.
Yeah.
But they distinguished it from that because of the
interesting. Yeah, no, I was just thinking of the Snowden and Wilson and the directors spending money because there was legal action taken against them in their conduct, how they conducted themselves as directors.
But were they still directors at the time that they were? So that could have been the key. He wasn't a director anymore, and he was trying to cease and desist them having any legal action against him.
Yes, because I guess then he'd probably be prohibited from being able to act as a director in any capacity.
I think that was also the part about being able to continue to do that. Yes.
Yeah. Okay.
Yeah.
All right. Okay. So I was a bit confused why the taxpayer actually bothered with this case. So because we have a tax determination issued by the Commissioner, and we have I think a 2013 case, which is Lambert versus the Commissioner on Taxation, on very similar facts, and it was clear that the interest expenses were not deductible for the taxpayer. So anyway, with that sort of segue, so this was about, basically it was an individual that had borrowed money and the interest expenses sought to claim the deduction. Now, the money that was borrowed was used by the family trust, of which he was purportedly the controller, and it was used to acquire a property that the trust derived rental income from, and it was also used to acquire shares which grew in value, and there were dividends from that as well. So the applicant or the taxpayer sought to argue that there was the nexus of the incurring of the interest expense with the deriving of assessable income, and it was back to the idea. So they obviously relied heavily on Forrest's case, which, where there was that fixed income element. And so the interest was deductible for the borrowing in relation to that, where it was linked to the unitised or the hybrid trust there in Forrest's case. for the Andrew Forrest Trust. But in this scenario, what they were trying to argue, it's like Forrest because I actually control the trust. So I've incurred the interest expense, and my expectation is, as I control the trust, I'm a beneficiary of the trust. The rental income that's going to be derived by the trust for the money that I've lent, or I haven't lent, that money that the trust has to acquire the rental property. As a presently entitled beneficiary, I anticipate to be a presently entitled beneficiary, so therefore there is the nexus with the interest expense for the beneficiary. And it was held, well, no, that's not actually the case. But what I thought was really interesting is that, and this has just sort of popped in the case, was that one of the key contentions of the taxpayer was his wife, and there must have been some dealings with Social Security, and maybe it was sort of like a threshold test under the Social Security provisions to get some government support, was that there was a determination issued by the Social Security and Child Support Agency Services, and there they concluded that actually the interest expense was deductible if at the time of incurring the interest you're presently entitled. And under this determination, it was concluded the taxpayer would be reasonably expected to derive income from the trust as a beneficiary. So it's sort of like he's just lobbed in there of relying on that Social Security determination. It is understood that determination has been held in abeyance subject to the outcome of this decision in this case, which is obviously a tax-specific case. The tribunal member said it was not bound by this Social Security child support determination. Most likely, I expect that that will change. And the outcome was that the deduction was denied to the applicant. And I think, as I mentioned, there is Lambert's case, which was a 2013 case on very similar facts. And there is a tax determination issued on the deductibility of interest in non-fixed trusts for beneficiaries. And that's tax determination 2018-9. The mere expectancy as a discretionary beneficiary is not sufficient nexus where you're hopefully going to get income distributed to you as a trust distribution, and you funding the trust and not charging interest is not sufficient nexus if you've borrowed the money as an outgoing there for you. So I think that's pretty typical principle that we've got applicable there. Okay, oh, I just realised it's past 1 o'clock. Oh no.
Yes. This one was really whether or not the applicant was an employee for SGC purposes, and whether or not they could be excluded under the prescribed person test, which just get slipped to what is required. And this law has actually changed, so probably not that relevant anymore, but just so you know, there is these prescribed people that aren't required to have super guarantee paid for them. Unfortunately, our taxpayer didn't satisfy these conditions because he needed to be a senior executive, he needed to have substantial executive responsibility. So I guess the lesson to learn out of this is that there are these prescribed employee tests. What you write in your migration applications when you've got an employee will get taken into consideration, so be careful, because in that one they described him as a cook, but then also were also saying he was also the chief operating officer, so quite a different job title there. And something that you just want to get right if you are going to go up against not paying super, because as we know the penalties can be high from This one's on demergers. It may be just relevant to know that it's out there, that they have what they've done with the draft tax determination. It has now been finalised, and this one is all on what is considered a restructuring. It can be quite broad, and events that happen before and after the actual demerger takes place can be taken into account in the actual what's considered the restructuring, and that would be relevant when you're considering the test for being in whether or not you're eligible for the rollover for demergers, in that you have to have the nothing else requirement after you've demerged the group, and you also need to have the shareholders have the same proportion and same market value after the group has been demerged. So I won't go into that one in any great detail, but if it is relevant for you, it is similar to the draft. There has been a few small tweaks. There's still the helpful examples in there, but it's just noting if you do have a demerger, normally most people get a private binding ruling, and I think now with this new TD and the expansion of what can be considered a restructure, I think that is even more important now to actually get a private class ruling or private binding ruling if you are considering to do a demerger that maybe has some other bells and whistles attached to it as well.
What always sticks in my mind with demergers is isn't it all, you've got to be able to sort of demonstrate better business efficiency?
Yes.
As a result of the demerger, yeah.
Yes, there's all sorts of demergers are quite hard to satisfy. This is just one element of it and what's considered part of the restructure, but what you're referring to is the 45B part of it, and whether or not it actually will be considered to be there be a business efficiency, and whether or not you can actually treat a dividend as a demerger dividend. So yeah, complicated.
Yeah.
So anyway, I'll leave those examples for you to have a look at in your own time.
Okay, so the just to do an update. So there has been an appeal, so that'll be interesting to follow that through. This is the Eichmann decision, small business CGT. This was basically the property or the adjoining land of a business carried on, and the adjoining land was used for storage of all the working equipment of the business. And the sale of the land was held not to be an active asset. I think Kirsty and I have different views on that.
Well, that's why I thought I'd put it in, because I thought it was here we go, we're going to find out.
Yes, so we'll have to stay tuned to that one as well. So it'll be interesting to see where that lands. And we'll see where it lands and what side of the fence, the Kirsty and Vanessa fence. All right. Dear. Yeah. So just really quickly, this is something Kirsty and I were talking about, just the reports. So the one I think that's the big one, apart from obviously the FATCA and common reporting standards, but just this taxable payments annual report. It's been around for a while, hasn't it, Kirsty? But it's new for
IT services.
Industries. Yeah.
2020 is the first year for the IT industry.
So it's going to be a big impact, and I think there are penalties that apply if you fail to submit the report, and so they're due by the 28th of August. And I think if you look on the website, there's some quite helpful guidelines. There is an online form that you can fill in, but it reminds me, probably before your time, Kirsty, but back to the old prescribed payment system, and so it was an obligation to withhold when you made payments to contractors in certain industries, and it was to avoid the phoenixing and the dodging of income tax and that sort of thing. There's no obligation to withhold, but it's just reporting. We've obviously got more sophisticated tracking and data analytics that happen now, but I think the big one is IT services, so contractors there.
So I just and also there's a requirement to lodge, even if a non-lodgement, so that you don't need to report anything. So you need to do that also if you're in one of these industries and you're not paying contractors or not required to lodge, then fill in the non-lodgement report. And then I'd also just recommend that maybe you look at your accounting software and whether or not it actually helps you. I do note that I had a quick look and Xero seems to have something that helps people lodge these TPARs. And so it's just, as Vanessa said, it's just reporting and gathering the information from the contractors, which should all be in your accounting software if you've got it. So just making sure that you do it before the 28th of August.
Yeah.
And
it's always just good, as a payer with contractors, just be rock solid that if you're not withholding PAYG and you're not remitting super, so you've taken the position that they're contractors, just make sure that they really are truly independent contractors, because you can still be caught for, in particular, super under a broader definition for contractors, where you might think, oh no, they're contractors, they've got an ABN, we're okay. That is not always the case. So just be, I think, in particular with these industries, because you are going to be reporting and you can see that the information has been provided there to the ATO for them to review and consider. So be wary of that. And then the other one, which is the Common Reporting Standards and the FATCA provisions, the reports there are due by 31 July. Incredibly complex. So it's an international exchange of information. We've got the special name for the US. They've got their own little sort of bubble of the FATCA. Everyone else globally refers to it as the Common Reporting Standards. There's an obligation to report to our Australian government via the ATO. If you do have, I guess, essentially offshore investments, but you still have to be what's considered to be a financial institution or reporting financial institution.
There's different definitions, and sometimes trusts might fall within there.
Yes, so, investment entities, aren't
investment
they?
entities.
But not your stock standard discretionary trust, but if you're performing particular sort of services, but just be careful about it. And generally, if you use a broker or a managed, a funds manager or something, they will be the ones that will be obligated to report. But nonetheless, just bear that in mind, 31 July for that. Okay. We better sign off. Yes, best we stop now. Thanks for joining us, everybody. And if you've got any questions, anything, suggestions, etc., so please contact Kirsty or I. We've got all our details there, and we look forward to you joining us. Is there one last question there, Kirsty?
Oh, no, that's a question we already answered.
Okay, that's cool. All right, we look forward to you joining us next month. Thank you.
Bye.